Good morning and welcome to your Sainsbury's third quarter 2019-20 analyst call with your host Mike Coupe. Mike, please go ahead.
Good morning everyone and Happy New Year and welcome to the quarter 3 Sainsbury's trading update call, which covers the 15 weeks to January the 4th. I'm joined here today by our CFO Kevin O'Byrne. I'm going to ask Kevin to run through some of our quarter 3 highlights in a moment, and then we'll hand over to you all for the Q&A. So Kevin, over to you.
Thanks Mike, and welcome everyone. I'll now take you through some of the key numbers. Looking at grocery first, sales grew by 0.4%, representing a continued outperformance of our key competitors in both value and volume over the quarter, reflecting the investments that we've made in the customer offer and in our stores over the last year and the ongoing improvements in service and availability. Behind the total sales growth of 0.4%, we saw lower inflation this quarter versus last year, so this actually represents a slightly better volume performance in a slower market despite a reduced benefit from new space. And we continue to generate strong growth in our online grocery business, up 7.3% in the period. General merchandise sales fell by 3.9%. Argos delivered a strong performance over the Black Friday period and outperformed a weak market in consumer electronics, but was heavily impacted by very weak toys and gaming markets where we have large positions, both of which saw double-digit declines. The gaming market in particular was down more than 35%, impacted by an absence of new product launches. Argos customer service metrics remained strong over the period, with more customers shopping online and taking advantage of our click and collect and delivery services. Prepaid click and collect sales, for example, grew by 16%, providing a great customer experience and of course reducing costs as people collected the products themselves. Finally, looking to clothing, sales grew 4.4%. Full price sales grew by nearly 8%, with sales of seasonal products helped by the colder weather earlier in the quarter, and sales were helped by very good performance from our Christmas party and gifting ranges. Online clothing sales grew by more than 40%, and in the period, total group online sales accounted for more than 20% of the business, up 5% year on year. So overall, a tough backdrop and some challenges in general merchandise, but a good performance from our grocery business in a weak market. Operationally, we were in very good shape across the business with strong availability and service, and we've exited the quarter cleanly from a stock point of view. We'll now open up the call for your questions.
Thank you. If you do wish to ask a question, please key star then 1 on your telephone keypad. Please stand by for your first question. Okay, the first question is from Andrew Gwynn from Exane. Please go ahead.
Hi, good morning all. Happy New Year.
Happy New Year.
So 2 questions for me. So first off, I'll ask the consensus question because I'm sure somebody else will, but your thoughts on this year's number, but perhaps also next year's forecast as well. Very early stages, I know. Second question, obviously some weak performance in the GM business, particularly as you mentioned in clothing and toys and gaming, but to what extent does that matter for profit? Is there a significant exposure from a profit point of view to those categories? Is it really just a bit of top line?
Well, I'll ask Kevin to answer both of those, I think.
Okay, Andrew, first on consensus, we don't traditionally comment on profit in a trading update, but as you will expect, if we'd something to say about consensus, we'd say it, so you can infer we're comfortable with consensus. Next year, from memory, consensus is up 1.5% or something. We honestly haven't completed our budgeting for next year, etc., but that doesn't seem unreasonable at this point. On the general merchandise, of course, they all contribute. You're absolutely right. Toys and gaming would be generally lower gross margin products in the mix, so they're less impactful than sales shortfall in some of our other categories like home, for example, in general merchandise. But of course, they all contribute, so we've had to do some good work on costs to manage the bottom line.
Okay, that's clear. And then just come back to the food business. And obviously, any sort of standout areas there? I mean, the performance for you is as you mentioned, better than peers. It was only the listed peers, at least. Thanks.
No, it's reasonably sort of even in its performance. The Taste Difference volumes grew, so that was a big tick in the box. We continue with the program of rolling out opening price points, so we're on track to deliver what we said we would deliver. and then there's a lot of store refurbishment that's gone on during the quarter. So it's a very rounded, sort of blended performance. The operational stats was probably the other standout thing where year on year, all of the metrics we measure on customer satisfaction moved forward. Our availability was as good as it's ever been, and things like speed of checkout were significant improvements year on year, which is testament to all the work that we've done in investing in self-checkouts, but also Smart Shop. Look at Smart Shop as a factor in and of itself. Around 15% of sales in the stores that have it, so around about 500 stores went through Smart Shop over the entire quarter, which shows how much our business is changing and how rapidly it's changing.
Andrew, just building on Mike's point, the Taste the Difference volumes grew, but Kantar data yesterday would also show that we were the only traditional retailer to show growth in value own label sales, so it was a very balanced performance.
Okay, thanks guys.
Thank you. The next question is from Maria Laura Adorno from Morgan Stanley. Please go ahead.
Yes, hello. Thank you for taking my question. I just had a question with respect to Space Edition. Maybe if you can talk us through the different dynamics into this quarter and how you see that evolving in 2020. And then the second question is coming back to toys and gaming. There is definitely a bit of a structural element, which is also the shift to people using more tablets and not necessarily playing with games. But just wondering, in terms of 2020, if there is any levers that you actually think could potentially reverse the trend seen in the quarter. Thank you.
Firstly, Maria, I'll talk maybe to the property ones. We've seen space reduction in broadly flat actually in food and reduction in general merchandise in Argos stores. The dynamic behind the scenes was we closed about 23 convenience stores, which we announced at the Capital Markets Day, so we've just been getting on with doing that in the period. So we had a negative space drag on the convenience business in the period. Clearly that's beneficial from a contribution point of view, and you'd expect that you would see in time space being reduced in the business, particularly in Argos, as we close existing standalone Argos stores and don't replace all of them with store-in-stores.
Yeah, and on the specifics around toys and gaming, you can take it as read that we'll do a big review post-Christmas, because clearly in the case of toys it's now the second year running where there's been significant reductions year on year, and we need to make sure that we're maintaining our market share and our competitiveness in that part of the market. On gaming, there's clearly a structural change in the sense that more gaming is going online, but this year it was mainly driven by the absence of a sort of big console launch, and we'd expect cyclically that would happen next year, this time next year. So probably a combination, as you say, of structural changes in the marketplace, but also we need to go back and make sure that we've got the right exposure to the right categories in those markets as we go into next Christmas. Of course, at this time of year and beyond, it becomes much less significant as a proportion of Argos's business, so it's really only in the key Christmas quarter that these categories come into their own and that they pay a disproportionate part of the Argos general merchandise sales.
Thank you. The next question is from Bruno Montagna from Bernstein. Please go ahead.
Good morning, everybody, and Happy New Year. My first question is trying to read in your commentary on whether the market in the UK is really getting worse or not. I took note of what you're saying about your fifth price lockdown, 1,200 products. At face value, they seem big price cuts. I look at the counter data showing market growth of 0.2%. Which is also much worse than before. So would you assess that today's, top line market in the market overall, the amount of price investments you guys have to put in is making things worse again, or is it the normal humdrum, unusual promotional and trade planning announcements? The second one is there anything more you can say about your new value-oriented products that you were launching when you had us at the Capital Markets Day? You made it clear they weren't going to get prime position. You thought that was necessary. Any changes in the way you're approaching the merchandising, the rollout, any successes or failures that you think are worth discussing? Thank you.
Yeah, if you look at the market, I showed a chart last night at our leaders group, which basically says the growth in the grocery market has stepped down from around 1% to, as you've already rightly pointed out, virtually zero. That's partly a function of value falling out of the market, and I guess if there's a structural decline in volume, it's probably too early to call it, but clearly the Christmas quarter would suggest that there's been a decline in grocery volumes over the quarter. Whether that's specific and uniquely to the last quarter, I don't think we'll really know until this time next year when we've got the sort of full extent of the overall trends. But probably the biggest headline driver of the market has been the reduction in inflation, which by implication is a result of the market being more price competitive. We're pleased in the sense that our relative volume growth is higher than our value growth. So from that perspective, we are seeing the actions that we're taking coming through in the stuff that we sell. There's not a lot we can add to the opening price point story in the sense that we don't do a lot of stuff in that area, a lot of category re-engineering over the Christmas period. We kind of get back into the full throw of that in the last quarter. So I suspect we won't talk more extensively about this until we get to our prelims update in May. So there's not a lot more other than what we've already said, and certainly not any significant changes in our approach.
Thank you.
Thank you. The next question is from Clive Black from Shore Capital Markets. Please go ahead.
Good morning, gentlemen. And a very happy New Year to you all.
Happy New Year.
Post the general election, everybody in the north is full of the beans of joy.
The red wall, Clive.
The red wall. And I just wondered, in that respect, Mike, given you are an experienced player in this industry.
You always say that to me. Thank you.
Do you see the potential, given given less uncertainty, and perhaps stimulation by the government through a variety of levers for household expenditure to improve? And in that respect, do you think it's reasonable that the grocery industry should capture some of that?
Yeah, I mean, certainly post the general election, we saw no difference in the trading pattern in our business. And I talked on the media call about the fact that you could characterise ours as almost twin peaks. We had a very strong month end in November. It then got really flat in the first few weeks of December and then peaked very strongly around the weekend before Christmas and Christmas week itself. So nothing obvious directly out of the general election. When it comes to how our customers are feeling, I suspect your analysis is right. It will largely come down to the sentiment out of the budget, probably as the next most significant event in March. In theory, at least, the customer trend should work in favour of retail in the sense that customers have more disposable income. Inflation is comparatively low, and therefore that should reflect itself in trading up in grocery and in people buying non-consumables. I think the story of Christmas will be that's not actually reflected in what customers have really done. And of course, another significant announcement in the last few weeks has been the 6% increase in national living wage, which again, you'd have to believe should ultimately flow through in customers having more money in their pockets and using that money to buy stuff that we sell. But to be quite honest, Clive, we're planning on the basis it's not going to get any better in the next year. And that we'll structure ourselves accordingly. If there are fiscal stimulus put into in the market as a result of the budget or anything else that the government chooses to do, then we'll benefit from that as and when that happens. But I'm not holding my breath.
And just your comment on national living wage, is that ahead of what you would have been expecting prior to the election?
Yeah, for sure. I mean, if you take the sort of general trend, it's of the order of 4.5%. So absolutely, but we're in a great position in the sense we made a big move to £9.20 an hour, so we've got plenty of headroom between where national living wage will go and where we are currently. And we reflected on the fact that having made that big year-on-year increase, we effectively have no wage inflation in the second half of this year. And as we look forward in next year, we'll obviously take a view on where we need to pitch ourselves in the light of the national living wage for the next wage round.
And just as a second and final question, should have from me, the 20% participation online across the group, where do you see that progressing? Just in terms of a general expectation over the next few years.
I think you could probably attribute 5 to 10% growth year on year. So, that will gradually move towards 25-30% on that kind of basis. Plus or minus a bit. And, to the question around space, you'd expect us to have less retail space in 5 years' time. So the way that the shape of the business in 5 years will realistically be probably 25 to 30% online, 75 to 70% through core physical real estate, and that's very much in line with the way that customers are choosing to shop. And we'll, hand on the tiller, steer the ship in that broad direction, assuming that nothing changes in the way that customers are behaving.
And Clive, you're seeing quite a dramatic change in Argos. If you look at year on year, we've gone from about 35% of the sales in stores last year. People came in, we didn't know they were coming before, they hadn't reserved or anything. This year it's dropped down to about 31%. So we're seeing quite a move. We've still got lots of people coming in to collect things in store, but that's also reducing slightly. So the overall store mix is reducing. The nice thing is our leases are on 4 years average leases, so we can change the shape of the estate as customer habits change.
Well, look, thanks very much for the comprehensive answers, and all the best, guys.
Thank you.
Clive.
Thank you. The next question is from Nick Coulter from Citi. Please go ahead, Nick.
Thank you. Good morning and Happy New Year. Good morning. Just, if I may follow up on your grocery volume comments, I'm not sure about the last 4 weeks, but I think Kantar has your like-for-like inflation as incrementally positive, and as you say, below the market. Would you broadly agree with that observation? Then secondly, still on grocery, on your promotions, could you comment on the shape of your promotions and your like-for-like promotions in or through the quarter? And I guess that's with regard to the usual levers of fuel, BWS, and I guess twist wraps, given the season. And then lastly, on general merchandise, could you give a sense of the negative space impact in the minus 3.9? My understanding is that there's a small positive contribution in grocery, so presumably there's at least a few tens of bips in the minus 3.9. And then I guess, sorry.
Oh, right, go on. Keep going.
Just sort of one supplementary, if I may, on Kevin's inventory comments. Clearly not a problem in clothing whatsoever, but presumably you successfully cleared the general merchandise inventory in the period. Thank you.
Yeah, I'll ask Kevin to comment on the second two, and I'll have a go at the first two. I think I'll defer to James to probably explain behind the scenes exactly what the shape is, but broadly speaking, our volumes, we're inflating less than our competitors.
Yeah.
Best way of summarising it.
So you have a negative mix as well, presumably?
Yeah, so the realised value per item is less than it was, if that makes sense, but you can. Yeah. It's probably better to have a more detailed conversation with James behind the scenes to sort of unpack the Kantar data, because it probably hides a multitude of sins. But by definition, if we're putting more opening price points into the business and that part of our business is growing, it has a effect on the average price per unit sold. And as we've described at the Capital Markets Day, our measure of success is that we grow our volumes and
sure.
Our cash profitability, which broadly speaking is in line, if not, we're actually achieving probably slightly ahead of that ambition. As far as promotions in the round, lots of noise, as usual, pretty intense trading period. But if you look at fuel and wine, we didn't really do a lot in twist wraps, but fuel and wine, we did more. But then all our competitors did more. And if you look at fuel stunts, number of days on promotion, then Tesco were almost twice where we were, and Morrison's were about 60% higher than where we were, and both of them basically added more days, and we added about the same number of days year on year. Similarly on wine. But on the other side of the equation, if you look at Kantar, it will show that our ongoing promotional participation actually dropped year on year. Mm-hmm. So in the round, we would take the view, and we'll need to do the analysis, so this is very much sort of first cut, but we take the view that broadly speaking the business was about the same promotional weighting year on year. So we think broadly speaking it plays a draw against a backdrop where the level of promotional intensity probably went up, and probably the most significant number is the fact that people like Aldi were actually more promotional year on year significantly more promotional year on year, which would suggest that they were also driving it, keeping their headline.
And Little, I guess, as well. Okay, no, that's helpful. Thank you.
Little ran a big Daily Mirror promotion, for example, which year on year was quite significant for them. Yeah. And then on space and inventory, Kevin.
Nick, on space, the impact of space reduction in the Argos estate would impact sales by about 0.4%.
Thank you.
And then if you look across stock, the areas we'd worry more about in general merchandise would be things like electronics, just because they have a short shelf life with technology, fashion items. So we don't really have an issue there. We clearly have a little bit more toys, but it's all stock that we can trade through in the coming period.
Okay, super. Thank you so much. Thank you.
Thank you. The next question then is from Rob Joyce from Goldman Sachs. Please go ahead.
Hey, good morning, guys. Happy New Year.
Three from
me. Quick, first one, on the food inflation, can you just give us an idea of, in absolute terms, what that inflation number is now running at and how that compares to the previous quarter?
No, it's a short answer.
Rob,
could you, maybe the size of the move, Mike? Quarter.
A bit of colour, Rob. It's less than 1%, and as you'd expect, the deflation in kind of grocery, meat, fish, poultry, produce, etc. in the period, and a little bit of inflation in other areas, not fresh areas, and broadly less than 1% across the piece.
Okay, and that's down, what, maybe 100 bps since the previous quarter, a bit less?
Yeah, it will be, because, and particularly with the mix of fresh and produce in the Christmas quarter, will impact that.
Okay, thanks very much. And then a couple more on the GM side of things. You mentioned that Black Friday was very strong. I think this time last year you were saying you didn't play in Black Friday. Should we read that as saying you decided this year you needed to get involved in Black Friday? And then the second one on the GM side, just give us an idea, if you could, what percentage of sales the gaming category represents. Thanks very much.
Yeah, on Black Friday, we didn't say we didn't participate last year. We just said that we downweighted some of the activity, particularly in the Sainsbury's channel, so we did a lot less in the supermarket chain. Black Friday this year was mostly helped by the fact that it moved back by a week year on year, and therefore it coincided with payday, which meant for the market generally and for us in particular, it was incredibly strong. But it probably, on balance, brought forward sales from the subsequent few weeks, and I've referred to the fact that you could argue, you could see in the Argos business, it was basically a story of two peaks, one to coincide with Black Friday, fueled by the fact it coincided with the payday, and then Christmas week itself, or the weekend before Christmas, was incredibly strong as well, but the bit in the middle was challenging, and I suspect that will be reflected across the market.
Mike, does that pull forward mean you sell more on discount?
No, we basically buy the stock to sell, and we'll sell it as and when our customers want to buy it. But basically, they have money in their pocket to buy it over the Black Friday weekend, and that was reflected in our sales and probably the market more widely if you look at the BRC data.
And Rob, on the size of the what we've talked about before, the gaming and toys market over the Christmas period will be just over 20% of the GM business. And we've got big shares in these markets. We've got about 18% of the gaming market in the UK. We've got over 30% of the toy market in the UK. So they're very important to us in this quarter.
And would they roughly split half-half, gaming and toys, within that 20%?
Toys would be bigger.
Okay. Thank you very much.
Thank you. The next question is from Xavier Lemene from Bank of America Securities. Please go ahead.
Yes, good morning and Happy New Year, actually. One quick one, actually, for me. You have been offering, better value in recent months, we can say, and you have been developing the entry price, products. Where are you currently in that journey? Do you think that you made half of that, or you're almost at the end? Just to go to what is left, for 2020, 2021.
Yeah, we said we'll be effectively 90% complete by the end of this financial year. So that's about 8 weeks to go, and I think we're 160 down and counting. So there's still work to be done. As we've already referenced, sort of the 6 to 8 weeks before Christmas, we don't do any significant category re-engineering because it's not a good time to be doing it, but we'll clearly get back into the throw of things in the final quarter. So work to be done, but by just doing the risk bit, we're probably 2/3 of the way through the range development as we stand today.
Right. And if I may add, actually, in terms of pricing, where do you stand today? Are you happy with your price positioning today, or do you think you need to do more going forward, especially given the volume improvement you had?
Yeah, I mean, we're happy with our price position in the sense that, it's a sort of measure of today. Who knows what the competitive dynamics will be in the future, and we'll, ride with the cut and thrust of a very competitive grocery market, and our ambition continues to be that we would want to grow our business across all of the category tiers, not just one category tier. So we would judge success not just by growing opening price point, but also by growing Taste the Difference, distinctive brands, and our standard branded and own label ranges. So to fill the bath evenly rather than at one particular end or the other.
Okay, thank you.
Thank you. The last question comes from Andrew Porteous from HSBC. Please go ahead.
Hi guys, and Happy New Year. A few from me, if I could do, all on the GM side. Just thinking about the mix of sales, particularly on the online business, you flagged that click and collect growing a lot quicker than the fast track delivery, and I'm just wondering whether you've got sort of one eye on running Argos a little bit more from a sort of with a focus on cash profit rather than sort of driving the growth in things like their fast track delivery. The second question, just on the toy and gaming category again. It just seems like a category where you seem to have struggled a bit more than some of the other players in the market over the past couple of years. And just wondering, is it a category where you underperform the market? And is it one where you feel sort of competitors are perhaps targeting you guys a bit, given you've got such a big market share in things like toys? And then the last one was on the consumer electronics side of things, where you clearly outperformed, but there's no comment on sort of the market. I mean, have you outperformed a good market there, or given the overall like-for-like, is it fair to assume that all categories across GM were a bit challenging?
I'll let Kevin have a go first, and
just afterwards. On the consumer electronic market, your last question, Andrew, the market is down a bit, and we outperformed it, as you said, so it's down a few percentage points. Now, we've only got detailed measure on the market up till the end of November, so we don't get the full December measure, but we think that trend continued. Toys and gaming, I disagree. I think we've held our share well over the recent periods. We've had a bit of share pressure recently in toys, in some of the infant and some of the preschool areas in a competitive market, but over a longer period of time, we've held our share there. We'll need to revisit that after Christmas, as we always would, and see is there more we can do. Gaming, we're comfortable with our share position in gaming.
Okay. Just to follow up on toys, if I could do very quickly. It's one where people were perhaps a little bit more optimistic this year because it seemed to be a few more events around Frozen 2. Did that just come a bit late and it just didn't come through, or?
Yeah, I mean, as Kevin's already said, it's too early to have done the complete post-mortem, but for the second year running, the toy business was down double digits. So broadly speaking, toy volumes have dropped by around 20% over 2 years. And as a big player in that market, we've clearly taken our share of that impact. The question that was asked earlier is what extent is that structural, as in people just fundamentally changing their habits, how much of it is cyclical because of the sort of release schedule, and that's a piece of analysis we'll have to do once we've seen all the market data. We don't see ourselves losing share in the way that you've described. Clearly it's a market that people would look at, or our market share people would look at avariciously, but nevertheless we think we've done a pretty good job of, broadly speaking, maintaining our share. And the other point to make, which is pretty obvious, is that those categories are disproportionately large in the run-up to Christmas and therefore have less impact in the sort of normal, such as they are normal trading periods post-Christmas and for the rest of the year.
Thanks, that's really helpful. And just on the profitability within Argos, have you been a bit more profit-focused?
Oh, we're always profit-focused, but we always strike the balance between offering fantastic value to our customers, maintaining high levels of service throughout our business, and generating profit and cash. But you can take it as read, and certainly in the analysis we gave at the Capital Markets Day, one of the key measures of our ongoing investor sell is the fact that we are a cash generative business and we will look to reduce our debts significantly over time. And we're in line to do that this year, and we'd expect to do it in the subsequent years on the back of the work that we've done, and clearly Argos plays a part in that.
Thanks a lot for the answers, guys. Really helpful.
Thanks, Andy.
Okay, thank you, everybody. I wish you all a happy new year. I'm sure we'll see you over the next few weeks and months, and wish us luck in the last quarter. Thank you.
Thank you, Mike. That does conclude the call for today. You may now disconnect. Thanks for joining, and have a very good day.